Hello everyone, welcome back to Market Champs. And today in this video of the series Intro to the Stock Market, I will be showing you the basics about options. Well, what is an option? Options are financial instruments that are derivatives based on the value of the underlying securities, such as stocks. There are a couple of things to know about options, and this picture represents them. This is how options on Apple look like in the Robinhood app, which I will be using during this presentation. We will start with the strike price. The strike price of an option is a price at which a put or a call option can be exercised. Next up is the break-even price. The break-even price is the amount of money which an asset must be sold to cover the cost of acquiring and owning it. Next is the changing option. The changing option states the difference between the current price and the previous day's settlement price. And then the price of the option. Option contracts represent 100 shares of the underlying security, and the buyer will pay premium fee for each contract and the seller will collect the premium. And you can't forget about the expiration date, which is the date the underlying option contract expires at market close. So for this option contract, it expires on November 20th at market close. What is the difference between buying and selling options? Buying options. You pay a premium for the options contract. And for selling options, you collect premium for the options contract. There are multiple things to pay attention to within an options contract. Starting off with the bid. The bid is the most someone is willing to pay for an option. The ask. The ask is the most someone is willing to sell this option for. Mark. Mark is the middle of bid and ask, which is market buy. Previous close is the price of an option at close on previous market day. The high is the higher price that the option has gone up to. The low is the lowest price that the option has gone down to. The volume is how many times the option has been exchanged throughout the day. Open interest is the total number of contracts that are currently opened. Implied volatility represents the expected volatility of a stock over the life of the option. Next up are the Greeks. Delta measures change in option price when the stock price moves. Gamma measures the sensitivity of delta to changes in stock. Theta measures time decay of an option for the day. Vega measures an option sensitivity to changes to implied volatility. And Rho measures the sensitivity of options price to changes in interest. Now let's go more into buying calls and puts. When you buy a call, you pay premium to buy a contract betting that the stock will go up. When you buy a put, you pay premium to buy a contract betting that the stock will go down. When you buy a call or a put, you can either close it before expiration or keep it till expiration depending if you're in the money or out of the money. On the top right corner for calls, when your contract strike price is above the share price, it's out of the money. And when the strike price is below the share price, it's in the money. Vice versa with buying puts. Let's look at an example of buying a call. Mainly what you will look at in an option is the following. Expiration date, which is November 20th. Strike price, which is $121. Premium that we will pay, which is the price times 100 shares, which ends up being $68. The break-even price, which is $121.68. Implied volatility, which is 30.66%. Volume, which is 46,940. Delta, which is 0.32, which is $32 per $1 of movement. Meaning if the stock goes up $1, you will be up $32, and if it goes down, you will be down $32. Theta, which for this option, it's negative 0.1979, which is $19.79 per day that will decay if you hold per day. And finally, understanding the risk of the option, which will be $68 if at expiration the price share isn't above $121.68. With buying puts, it's the same thing that you will look at. It's just that with buying puts, you are betting that the stock will go down. Moving on to selling calls and puts. With selling calls, you collect premium to bet that the stock will go down, and selling puts, you collect premium betting that the stock will go up. When you sell a call or a put, you can either close it before expiration date or keep it till expiration date, depending if you're in the money or out of the money. On the top right corner, it shows that when selling calls, if your strike price is above the share price, you will be in the money. And if it's below the share price, you will be out of the money. And with selling puts, it's vice versa. Moving to a sell call example. The only thing different about it from buying a call is that you will be collecting premium. Now there are two options that you can go about. Path number 1. The collateral that you will be putting as a seller is 100 shares. If the stock is above $121 at expiration, collateral will be given to the buyer and the seller, which is you. You will get the premium and $12,100, which is $121, which is the strike price, times 100 shares. Path number 2. Collateral is 100 shares. If the strike price is below $121 at expiration, collateral will not be given to the buyer and the seller, which is you again. You will get to keep the premium plus your collateral, which is your 100 shares. Moving to selling puts. Selling puts is the same information to look at as buying puts, but now you will be collecting premium. With selling puts, there are two paths as well, but now collateral will be the strike price, which is $121 times 100 shares, which equals $12,100. If the stock is above $121, the buyer will not get collateral, and the seller, which is you will be getting the collateral back and get to keep the premium. Path number 2. Collateral is still the same, $12,100. If the stock is below $121 at expiration, the buyer will get the collateral and the seller, which is you, will get assigned 100 shares and get to keep the premium. Later on, when you get more comfortable in buying options and selling options, you will be able to start doing more complex strategies with options, which, for example, are credit spreads, iron condors, and butterflies, and the list goes on. A website that I like to use to go over my options trades before I purchase them is optionsprofitcalculator.com. Alright everyone, that is the end of the video. If you have any questions, comments, or concerns, please comment down below. And if you gain knowledge from this video, please like and subscribe for more content. The link for this Google Slides will be in the description, as well as my Discord and the options website. Thank you everyone.